All right, welcome. Come on in. Yeah, have a seat, guys. Don't be a stranger. They just want to make sure it's good, so they're like, if I want to leave, I'll be near the door. All right. Thank you all for coming. I think if you are here, then I guess maybe you know a little bit about Coffee Trading Academy, but we are focused exclusively on one thing. We have coffee trading on our brain, coffee trading on the mind 100% of the time. So we are focused exclusively on the global coffee market. Although we're focused only on the coffee market, we offer two services. We do high-quality research on the one hand and high-quality training on the other. And that's kind of the theme of today's talk. We're going to give you a nice sandwich of value here with some sort of theoretical concepts mixed in with some of our latest research here. All right, so here is our agenda. You may be wondering why there's a little ninja on the screen there. In one of my first videos I made a little throwaway joke about how, I'm a coffee price risk ninja, and I spent like an hour of my time making this ninja in PowerPoint. So I kept him around. I like him. He's a coffee ninja. His name is Joe. Get it? Yeah. All right. So we're going to start out by giving you an outlook on the market. I'm going to tell you where I think we're going. I'm going to give you my price prediction. Then I'm going to give you a little bit of an introduction to the Coffee Trading Academy. Then we'll move into sharing my secrets with you, tell you about my methodology for analysis, how we do it, why and how we make predictions. And we're going to use that kind of mentality to come up with a framework for analysis of the market, all right? And then we're going to conclude with a little lightning round. We're going to zip through all of the fundamentals, all the different things that we started with, and we're going to kind of use it to apply, and we're going to come up with a prediction for the market in real time here. All right, so what is in my crystal ball? What do we see for coffee? What do you think, Joe? He's bullish. He wants $3 coffee. But if we look at the fundamentals, my view is that we are actually a little bit overvalued versus the stocks-to-use ratio, okay? Now, there is a strong possibility that we continue to rally. We could make new highs. We could go above 250. We could see Joe's little $3 there. Yeah, he's pumped about that. But I think that if we look at just the fundamentals, we have to think that it's a little bit overvalued. And we'll talk about why. But who am I and why am I making predictions on the coffee market here? Well, my name is Ryan Delany. It's nice to meet you all. I am first and foremost a coffee trader. So that means I started out trading certified and specialty coffees, first in India and then later in Uganda. Then my son was born. My wife decided she did not want to have the baby in Uganda, so we came back to New York. I was trading with a company called Ecom, very large international coffee trading company. And back when I arrived in the States, Ecom had actually just started a hedge fund. And my intellectual curiosity got the better of me, and I was attracted to the volatility and excitement of the futures market. So I applied for and was accepted to do a position with the hedge fund as a coffee and cocoa analyst and trader, which was fascinating. It was really cool. It was really exciting. And that was where I really delved deep into analysis and how to think about the market analytically and what different tools we can use. Ecom had a very fantastic network around the world. So I really was able to get a kind of comprehensive education on thinking about risk in the futures market. But I'm a coffee person. You guys are all coffee people. And if you are a coffee person, you know that we like being around people, right? That's why this convention is so cool that we're finally all back together again, right? I was just saying to some of these people here, I feel like all I know is your profile pictures online, right? So it's funny to actually see people in person. So I missed that in my ivory tower in the hedge fund with all of my money. No, I didn't have much money, actually. So I went and transitioned to the sell side. And on the sell side, that was actually very, very cool for me because I was able to use my experience in risk management in the coffee futures market, and I essentially became a financial advisor. So I was advising roasters and producers and the trade on how to manage their risk in the futures market. And that was really cool because it gave me a much broader exposure to people in the market. And that helps to understand what different people's motivations are in addition to the risks and everything. One thing I will mention very briefly, I did used to be a Marine, so I throw out these like military terms and stuff like that, but I promise I will keep that to an absolute minimum. About a year ago, I launched Coffee Trading Academy. So we're on April 16th, we'll be 1 year old. So yay for that. Thank you. Part of my mission at the Academy, a lot of people out there who talk to you about the market, they want to be like, oh, I am the one person who will tell you what's going to happen in the market. And I don't believe in that. I'm really trying to democratize access to information in the coffee market. So I try to make it simple, easy to understand. I even tell my competitors what I think, and I say, look, this is how I look at the market. I'm trying to be respectful of your time. That's why I've got lots of pictures and cartoons and stuff. It's not about being cute. It's just about being efficient in how I deliver information to you. Oh, and I've got YouTube videos as well. My kids say I'm a boring YouTuber. Now, a book that was very influential in my upbringing as an analyst was this book called Super Forecasting. All right, The Art and Science of Prediction. And this book tells a story, which is actually a true story, about the American CIA. And you may wonder how they have any business trying to predict the future, and that's exactly why they did this. They did a study on who is good at predicting the future, because they had just recently failed in their mission. They had numerous intelligence failures, most notably the infamous WMD in Iraq, and of course, they infamously said, there's slam dunk intelligence on these weapons being there. And then, of course, that turned out to not be true. So they did a lot of soul searching on why that was, how they made such a terrible mistake. And what they did was they had thousands of volunteers predict the future. They had a contest, essentially, and they tried to find out who was good at predicting the future. Then they took the ones who were successful. They dubbed them super forecasters. And they tried to find out what it was that made these super forecasters so successful. And what it was can be boiled down into a single word: quantification. So what these super forecasters did that was different was they put numbers on all of the different possibilities and all the different outcomes that could happen. So specifically, they were looking at impact and probability. So they would put numbers on what is the potential impact. Is it a binary yes or no outcome, or is it something of degree? And then what is the probability of that outcome? Not slam dunk, but is it 60%? Is it 90%? Is it 93%? So that's what these super forecasters did. And there's the third thing that they did that made them special, which is that they were constantly revising. This was not a one-time deal. You make your opinion and then you stick with it. You were constantly updating and putting in new numbers. I mentioned to you that I was raised as a trader, and one thing I always learned as a trader, and whether you guys are in the roasting side, whether you're on the producing side, or whether you're on the trading side, you're probably doing the same thing, which is you need to be on the phone every day, right? You need to be talking to your suppliers, you need to be talking to your colleagues, you need to be talking to your finance team, your logistics team. You need to be understanding what's going on. So that's the other aspect that I try to do in my business, is we do quantify, we do put numbers on everything, and then my clients in Origin will tell you, Rodrigo will tell you, I'm constantly calling them, texting them, what's happening to them, and saying, hey, this is my number, does this make sense? Is this reality, right? So that's another important side of it. All right. So really, what we're looking at is forward risk, right? The future is uncertain, just like my little ninja here navigating the waters above the sharks. Whether you're a CIA analyst trying to understand and quantify geopolitical risk, or you are a market analyst trying to understand market risk or the financial risk, right? You're trying to put numbers on the uncertain future. All of us here have exposure to price risk, right? We, for better or for worse, it's the livelihood we chose, have to deal with risk, right? We are exposed to the market. So what I want to impart to you guys today, and what I think is important, is that you understand what the risks are, and when you want to offload that risk, and when, if you think the risk is moving in your favor, when you want to take on additional risk. So that's my methodology, that's my analysis methodology, that's the secret sauce that I try to preach, is we're quantifying forward risk. We're trying to put numbers on it. And of course, as we said, that's impact on the one hand, and it is probability on the other. And then we're, of course, revising it on a daily basis, right? We're not just resting on our laurels. So if that's the mentality, if that's kind of the mindset that we have for analyzing the market, let's build together a framework, okay? This is what I send out to my premium clients It's a coffee valuation score. And what I do is I break down the market into 6 different categories, and I quantify each of those categories in cents per pound. We start with the fundamentals, and of course that, supply and demand, that is where I believe, and I think most of us here believe, is the driving factor in the markets. But we also look at technicals, which from my perspective is really about market psychology and crowd psychology. We look at positioning, who's long, who's short, what are the specs doing, right? Weather, anybody who's been trading since at least July knows that this is important, right? Macroeconomics, currencies, these are all big influences on the market. Seasonality, because coffee is an annual crop, it has an annual cycle that impacts price, right? It's probably the least important of all of them, but it's important nonetheless. And of course, we're trying to quantify all these. We're trying to put them in cents per pound value. Now, fundamentals form the core, right? And that's supply and demand. But one thing you may have noticed, and I've certainly noticed, is that even when the fundamentals don't change, what changes? The price, right? Just because the fundamentals stayed the same doesn't mean the price isn't going to go up and down on a given day, right? So there's a lot of volatility around that. But we still think fundamentals forms the core of the long-term view. So the analogy that we like to use is the treasure map, okay? So we might know, okay, the fundamentals say that we are here. Maybe we're in a current deficit in the market, right? And we know that the fundamentals say we're going to go there. In our case, we think that there could be a small deficit in the 22-year. But we don't really know what's going to happen in the meantime, right? We don't know if this octopus here, the macro event, is going to come up. We don't know if there's going to be another frost or a drought. We don't know what money flow is going to happen. If a line crosses another line and the moving averages change and then the specs decide to go long and dump $1 billion in coffee, that can have a big effect on the price, right? So how do we quantify this? How do we put our treasure map into price? Well, we do it with a price model. You can tell I'm a dad because all my pop culture references are 20 years old. But we make a price model by taking the S&D. Sorry, you guys threw me off. That was funny. That's Ben Stiller. He's a model. All right, yeah. So we convert the S&D into price, all right? That's the whole point of a price model here. So this is my price model. The blue line here represents the actual market price. So that's a monthly average price of KC over time. The orange line and the gray line here, these are my price models. And what you can see is that they actually correlate pretty well with prices, right? So let me get my little pseudo laser pointer here. When the price model says that prices are low, prices were pretty low. When the price models rallied, you can see that the market rallied, and so on. That relationship holds. So this is where we are on our treasure map here. We are in that deficit year, and we know that we're looking to move into that that small deficit year in 22. So how do we build the price model? Well, it starts with a chart like this. You all probably are either producing these in-house or your trading partners are producing these for you and sharing them with you, right? So we can see here that we have supply in the blue lines here. We've got demand in the orange line. And then below that, so if you have a surplus, well, let's put it this way. Below that, you've got your balance, okay? So let me get my laser pointer again. So this is a deficit up here. Here's a surplus. And of course, above, if you have more supply than you have demand, you have a surplus. And if you have more demand than supply, you have a deficit. Now that will translate into the stocks, okay? This is here is the GCA stocks just over time. But you can see when there's deficits, the stocks drop. And as there are surpluses, they rise again. And the stocks are really kind of the secret sauce for price prediction. Inventory levels, right? If we take the stock levels and we add our special ingredient to them, then we can predict price. And of course, that ingredient is consumption. When we combine stocks with consumption, we can turn the fundamentals into a single number, and that is stocks to use ratio. And the stocks to use ratio is very easy to calculate. So let's say, for example, you have 22 million bags of stocks, and you have 100 million bags of annual demand. Your stocks to use ratio would be? Well, yeah, okay, in months to use, yeah. What about in a percentage? Got some math majors in here? No? 22%, right? So the math is simple. You just take your global stocks divided by annual demand. A lot of roasters especially think about it in terms of, like Will said, in weeks of consumption or months of demand, but it's really the same thing. It's a stocks to use ratio. So we can plot that over time and it'll look something like this. Now, the stocks to use ratio, you can see here, has a very strong correlation with price. When stocks are very high, when they're 90% of annual demand, then prices are low. When those stocks fall, when they plummet in those years after 2006, then prices rallied, right? And that relationship continues. The stocks increase back up to 70%, then prices fall again, and then you can see the last couple of years we had a big drawdown in stocks, and prices, of course, rallied again. Now you can just pretty much turn this upside down and overlay it on prices, and then that is a price model right there. That's a pretty good price model, right? You can see how close that relationship is with really no math. Now there is a bit more to it. Remember, we're trying to calculate forward risk. What I just showed you was pretty much the present, right? That's what's happening right now and the past. But if we want to predict what stocks are going to be, this is where your expertise is going to come in. You have to understand the biology of the coffee plant. You have to understand origins, where coffee is grown, what's going to happen with weather. If we get another frost, how is that going to impact supply and demand? We have to understand destination markets. How is consumption going to be affected by economics, by COVID closures or geopolitical risk? We compile all that into an S&D, and then we can make predictions about what stocks to use will be. And of course, that's going to also take a good network. Remember, we're going to be talking to our friends every day. But that's a little bit fancy, it's a little bit complicated. I want to give you something that you can use right now as kind of a back-of-the-envelope calculation to just understand and make real predictions on price that's not just, oh, I'm bullish or I'm bearish, right? And that is based on some kind of math or some kind of fact here. Oh, so this is what we used to say in the Marines. I'm going to break it down Barney style for you, okay? So if we do 3 steps, we observe, we measure or quantify, and then we compare, okay? So here's our supply and demand. So we observe the balance. We quantify how much of a surplus or a deficit there is, and then we compare that to the market. So we can look at how that plays out. We can say, okay, we've got some deficits here, and that increased the price X amount. We had some surpluses, and then the prices fell this much, and so on. And you can see this correlation continue. But you can actually just quantify that. You know, if you have an S&D, you can take the balance sheet, say these are the balances, throw them into an Excel sheet, and compare that with price, and see what normally happens to price when we have a big deficit, or what normally happens to price when we have a big surplus. And that will give you a better idea than just saying, oh, I'm bullish or I'm bearish. Now, this is the caveat here. You also have to think, how much of this have we priced in already, right? The market is always forward-looking. We're not just concerned with what's going on now. We want to know what's going to happen. So that's how we quantify fundamentals. That's how we come up with this top line in our scorecard here that we send out to our clients. But let's go through our crystal ball. Let's dive through the rest of these fundamentals, or rather these other categories real quick. And we can see how else these other factors are going to influence price, and we'll see what our final analysis says. All right, so remember we've got fundamentals, macroeconomics, weather, technicals, positioning, and seasonality. We already covered fundamentals. What's the most important currency we all need to watch? It's not a trick question. That's right. The BRL. Why? Because Brazil is the world's largest producer of coffee, right? When Brazil, how's the saying go? When Brazil sneezes, the world catches a cold, right? So this is important for the actual final price of coffee because the Brazilian farmer sells in real terms, or at least they usually do. So that means that, and this chart's a little bit confusing here because lower is higher on a USD to BRL chart. So when the BRL in blue here is firm, right, then coffee prices rally. When the BRL weakens, right, you're getting more reals per dollar, then what happens to coffee prices? They go down, right? And that relationship is very consistent. All right. Now again, we want to quantify this. So for you at home, if you want to think about how is this going to impact the market? What I do is I look at peak to trough periods and say, okay, this period, the BRL had a peak to trough improvement of this percent or a depreciation of that percent. And then you can look at coffee over the same time, and that'll give you a ratio that you can apply. So now we just need to predict what the BRL is going to do, right? And that's easier said than done. So here's your 10-second history lesson on the BRL. BRL was very firm for a while, right? I think the Brazilians in here remember. You were getting great rates when you were coming to visit us in the U.S. And then what happened? We had a historic devaluation. The BRL went from 3 to 330 to a range of about 5 to 575, right? And that influenced us for a long time. We had a lot of very low prices, but the Brazilian farmer was relatively happy. Why? Because they were getting lots of real per pound of coffee. Now, just a couple of weeks ago, we had a breakout. We had a bullish breakout, and now everyone's losing their minds because the Brazilian central bank has the highest interest rate in the world, and the Brazilian real has got a great return and has got great prospects. It all seems very bullish. Our view, and this could be very wrong, but economists are predicting that fair value for the real is something like 540. We also have the elections coming up. Typically, my understanding is that the elections are just overall bearish for the real, no matter who wins. And depending on which candidate wins, it can be even worse, right? Plus, the Federal Reserve is raising interest rates, and so that'll make the Brazilian central bank's interest rates less attractive as a result. So all of these factors give us a slightly bearish view of the real. Again, we could be wrong. We're in a very strong market at the moment. But if this is true and the real weakens, we can quantify that and say that's going to have a negative impact for coffee. So we can add in 7.5 cents of decline there. The other currency that's important for the price of coffee is the US dollar. Why? Because our futures market is priced in dollar terms, right? So by definition, when the dollar is strong, you get more coffee for it, right? When the dollar is weak, then you have to pay more dollars, more weak dollars for your coffee. So you can see that relationship playing out here. When the dollar declines, commodities become more expensive. When the dollar rallies, commodities become cheaper. And that relationship generally holds. Not always, but generally. So here's your 10-second history lesson of the US dollar. Things were great. Economy was wonderful. Nothing can possibly go wrong. Then what happens? Oh, COVID happened, right? Well, actually, lots of horrible things happened, but we won't talk about those. Then we had COVID happen. Then we had QE. So the Central Bank of the U.S., Federal Reserve, they unleashed helicopters of money that devalued the dollar, right? So we can see the dollar devaluing there. But then, funny thing happened. The economy started doing great again, right? The Federal Reserve started talking about tapering. We're going to stop printing quite so much money. We're actually going to even raise interest rates, and so the dollar has been doing quite good. A sort of more sensitive reason the dollar has been rallying, there's been geopolitical risk. Whenever there's strife or conflict in the world, the US dollar tends to appreciate as people seek safe haven assets. So our view for the moment is we're a little bit bullish. We think that the dollar can continue rallying, but we think a lot of the bullishness is already priced in, so we don't see a huge continuation, but there is additional room to go there. If that happens, strong dollar means that you pay less, you need less of your strong dollars to buy coffee with, so that's a negative for coffee, and we can quantify that. Now with weather, there's two main ways that we want to look at weather, right? The first and best way is to say, hey, there's a specific weather event coming up. We can see it on the charts. We can see it in the forecast that there's going to be El Nino. That's everyone's favorite thing to talk about. Or lately, a frost, right? Those are the two big things that happen, droughts and frost. So we can look at what the specific event is. We can anticipate how that's going to affect production. And then we can use that in our price model to get an impact. However, things are pretty good right now, right? I mean, not necessarily in the past. Colombia obviously had a lot of issues, right? That's been a problem. But the current wetness in Colombia is not is bad for the matraca, but going forward, it's pretty decent for the main crop, at least at the moment, right? We can't predict frost this far out in Brazil. None of the long-term charts are saying that there's an overly large risk of drought in Brazil. So we can't use any specific event and price that. We can, however, look at general weather and how much that influences the market just by using some basic statistics here, right? June through DEC, what happens? We have a risk of frost and drought in Brazil. June through August is frost season. You better believe that we're going to start rallying in anticipation of frost, right? Everyone is freaked out over what happened last year. Then September through December, maybe January, that's when the risk of drought comes. If we look at this in the last 120 years, there's been, say, 25 events of either frost or drought. And so there's actually a very high chance of having some kind of weather event, right? We can put numbers in on that. There's a 21% chance, right? 25 out of 120 there. However, coffee has been moving lower, right? All of our Brazilians will tell you that they've moved, or rather moving higher, moving north out of the cold regions, right? So we can say that there's less of a chance for frost now than there has been in the past. So maybe we take 5% off of that risk there. And per event, per frost or drought event, maybe there's a 10 to 60 cent range on what could happen depending on the intensity of that. So we apply 35 cents as our average times 16%, and we can bake in 5.6 cents of weather risk. Now, we talked a lot about the stocks to use, but here's where we are now. We had two big deficits that dropped stocks way down. We're now looking at a small deficit in 2022, perhaps flat, but that's going to depend on what? It's going to depend on Brazil. And we're only a month out from the crop. I actually even drank some fresh new crop coffee today, so I guess they're even starting a little bit of that harvest. But we still don't know what the crop is. People tell you they know, but we don't know, right? Not until we get exports and we get stock checks. My estimate, I think a good consensus number is about 60 million, right? 22 of Connie's and 38 of Arabica. But there's a lot of people who are on the 55 range. If you follow financial Twitter, you know there's people who are a lot more bullish than that, right? There's also, I did an interview recently with Carlos Mera of Rabobank. He just did his crop tour in Brazil, and he said something like 64 million, right? There's still a lot of variability in how that Brazil number is going to shake out. And that makes a big difference on whether we are in a deficit or a surplus. So my little ninja here is just indicating that we're going to be watching this closely. We're going to be revising our numbers based on what we see. All right, so that can be a deficit or a surplus. Now, I showed you two price models before, so I just wanted to quickly tell you why there's two. One of them is only stocks to use. And what I want you to notice here is that this stocks to use, at least on this chart, is the highest it's ever been, which means that it's the lowest. It means the stocks are the lowest. Our stocks to use ratio model is the highest it's ever been. Why is it so? Why is the market not as high though? That's because of our other price model here, which has the BRL in it. So when you include the very weak BRL, that really undermines the low stock situation. And in my view, that's the main reason why we haven't been as high as we have in previous years. So I use an average of the two, and I call fair value something like 190 cents. Now, I said at the beginning of this talk that the market is a little bit overvalued versus our stocks to use price model. This is what I mean by that. You can see it visually right here. We're a little bit overvalued. Now, I want to point out something else. We've been overvalued before, right? So just because we're a little bit overvalued doesn't mean that the market's going to fall, right? We can easily rally another 50 cents here. But what I can't do is justify it. I can't say that it's warranted based on our stock levels. So our price target here is 190 cents. Now we just put it all together into a little basic math. We say 190 cents plus our weather premium minus our currency impacts. And we can add in some other things here. We can say the market's long, the specs are still long, so that can be a negative. And there's some other factors. And we get a target of 158 cents. Now this is something we're going to keep revising. And what I want to impart to you here is that I'm not saying market's definitely going at 158 cents. I'm just saying that's what I can value. When I look at all the different factors that I know of that contribute to price discovery, that's what I get. And what's helpful to you here, I hope, is that if you want to disagree with me, that's great. But you can even point to the part where you disagree with it. And you can say, look, I don't think that your macro forecast is correct, or I think that you're undercounting the impact of the deficit. any of those things, but at least we have a framework that we could talk about with, right, that we can discuss. Now, there's a lot of variability here too, and we just highlighted some of it, right? If the Brazil number is a lot more bullish than everyone thought, then the market could rally that much. If it's better than everyone thought, then maybe we knock another 15 cents off the value. If there's a frost, we all know what's going to happen if there's a frost, right? If, let's say, the dollar is not as bullish as we think, and it actually comes off in value, that can contribute to a rally there. The BRL, maybe we have an even crazier candidate. Sorry, I mean, that's not on any particular candidate, but if you have a terrible candidate in Brazil, then maybe the market crashes there, and that would be a major negative for coffee. Just my clicker. Okay, yeah, then it's just some other factors. So that's just kind of visualizing how all that can look. So the purpose of analysis, what I'm trying to impart to everyone and what I hope is useful here is we're trying to think about risk, right? Just like my little ninja tightrope walking over sharks. So whether you're exposed to the futures or whether you want to calculate your risk to differentials or maybe to currencies or logistical concerns. This even looks kind of like a shark, right? All right. Anyway, whether you're looking at any of those, quantifying it is going to help you to clarify your thinking, right? Just like we were able to talk about, okay, hey, I disagree with this portion of what you're pricing in here, or I disagree with that portion of what you're pricing in there. But at least we can talk about the scope, right? And we can be clear about what it is that we're talking about. It also enables you to have layers of depth to your view, right? We all talk about the market. We all like to talk to each other about, hey, what's your view on the market? What do you think about the market? This is going to help you to have depth to your view. So it's not just, oh, I'm bullish or I'm bearish. You can say, look, I think fair value is this. We are above that, but I know that there's a lot of upside risks. I think the upside risks are maybe more powerful than some of the downside risks, but I still think that we're overvalued. And that is going to enable you to do thoughtful planning, right? And that's what's going to be important for you and your businesses. So I was going to say that I hope you enjoyed this presentation, but who am I kidding? I'm a great teacher. I know you enjoyed it. But hopefully it was useful to you, right? But don't get cocky. We've only just scratched the surface here. This is just a kind of highlight, a couple of greatest hits of my Coffee Traders course. It's a 5-day course. In that course, we cover commodity markets, fundamentals, technical analysis, derivatives, and price risk planning. We put it all together so that you can kind of come up with your own risk planning strategies. If you're interested, you can check us out there on the web. We actually have a course that we're doing later this month. We just had one of our students has postponed their ticket, so we actually have 2 seats left. If you're interested, anybody who's attended the talk today, you can get a 10% discount on the training. And the other thing, as I said, is I'm trying to democratize access to information. And that's why I offer free reports. If all you want is free reports, I have better free reports than anybody else. If you want a little bit more substance to it, if you want some analysis with that, then I offer premium reports. And you can check those out online. But as long as you're exposed to risk in the market, this is what I try to do. This is what I try to preach and to assist with. Any of my clients will tell you that I'm always available, happy to discuss what you're seeing or give my view on what I'm seeing. So yeah, so join us online and subscribe or register for our class. Thank you, Joe. We appreciate your assistance here. And that is my talk on analysis. So with that, I think we can raise the lights a little bit and go to questions. Thank you. Do we have any questions? Yes, Dr. Will.
How big are the bulk freight happening out of, let's say, Indonesia to Antwerp or Indonesia to New Orleans? And that's it. If one of those vessels sink, is like I don't know, 250,000 bags out of the stock to usage ratio?
Well, to be honest, I hadn't even considered vessel sinking in my analysis here. So now maybe I'll have to add that in. I guess you would basically just, to your point, you would look at what is the quantity and how is that going to impact the supply and demand, right? And if it's expensive enough, maybe we'll get a submarine and you send some people down there to get it. Did we have another question? Yeah, go ahead. Sorry. Yeah, you and I.
How do you incorporate the increase in the cost of fertilizers into your analysis?
It's a good question. It is a big impact, and it's something that we've been looking at closely. I think my subscribers know I've been talking about it regularly. Here's my general thoughts on it. Number one, it has the potential to be a big negative to the coming crop, right? Right now is obviously not an issue, but the other factor is that it's not really a supply problem, right? It's not like there's not enough fertilizer. My understanding is that there's plenty of fertilizer to go around. The problem is it's a cost problem, is that it's expensive, right? So we don't quite know how that's going to play out. My understanding is that the Brazilian government just announced a major financing program to assist farmers with getting fertilizer. Plus, this is pretty much the best prices they've had in a long time. So they have every incentive to invest that money in fertilizer. And here I'm talking out of both sides of my mouth, but on the other hand, 80% of Brazilian farmers are smallholders, right? So even if there's getting a big incentive, they just might not have the money or the inclination to spend it on fertilizer. So it's definitely on our radar as a potential negative to the coming crop, but it's not quite straightforward to me yet on to what degree. Yeah, pleasure. Yes, sir.
I guess another logistics question.
Yeah.
How do you see the current problems in global logistics impacting the stock to usage ratio? Do you apply something?
Yeah, I think that goes into the slide where I said about, it's not quite that simple. There's a few other things that go in. So I think it's a big deal, and my view on this is evolving. Until today, pretty much, or maybe the last week or so, my view was that logistics are improving, COVID is basically done, and this is going to start picking up and going the right way. The fly in the ointment is Russia now, right? With sanctions, that is, I've been told, have been adding a whole new level of complexity and delays and shortage of containers onto that situation. So that is now a new factor we have to consider. And I was just talking to some exporters today, and they were saying about how pessimistic they are on logistics. So that is definitely evolving, and I had hoped that it was going to be improving, and it looks like maybe it's going back the other way now. Yes, sir.
Some of your models, when you show stocks versus prices and everything, they roughly line up.
Yeah.
Well, is there a similar correlation between the pricing activity in the market versus the pricing differentials?
Yes. So this is something we covered in depth in the course, but it basically goes like this. You have to think about it from the perspective of the end user, right? So if you're a roaster, to some degree, you don't care about differentials. I know you do, but to some degree, you just care about what's your final cost, right? At the end of the day, you have to pay cents per pound. In reality, they like to fight 2 cents over the differentials, and then you might lose a lot on the futures, right? But what they should care about is that total final price. And the same thing if you're a producer. You don't really care as much about the differentials. If the market's at 250, you're like, whatever, I'll 2 cent differential. I don't care, I'm making lots of money. But if the market's at $1, then you're going to say, well, I need a 50-cent differential because I'm not going to cover my costs. So in general, there's an inverse relationship between futures and differentials. That's kind of your baseline view. And then each individual origin, also their S&D is going to influence that on top of it. Yeah.
How do you explain,
Yeah, raise your hands. No, I'm just kidding.
sorry.
You're good, Gretel.
How do you explain what happened this year? I mean, it's been like a shocker for everyone to see that the beer market just went up and the differentials went up as well. And I'm
I'm used to seeing what you do in Spain, but this year was shocking.
Yeah, absolutely. Well, I mean, in some ways it wasn't a shocker, right? In the sense that Colombia had problems, right? and when you have problems in supply, that's going to be reflected in differentials, right? I guess to your point, the shocker is that you have $3 coffee and you have, well, not $3, but $2 coffee, $2.40 coffee, and 60-cent differentials or whatever, right? But it actually makes sense if you think about it. And this is why we say that, that's why I use differentials as kind of an indicator of bullish and bearishness too, is because what are the two biggest Arabica markets in the world that we care about? Brazil and Colombia, right? So if you have a problem in Brazil and you have a problem in Colombia, then you're going to have high differentials in both of those markets, and you're going to have a high futures market. Does that answer your question? Cool. So I hate to be so good at answering questions, but if anybody else has one, I'm happy to, and modest too. Cool. Well, please feel free to email me if you have any questions. Like I said, we have free and premium reports, so I'd encourage you to sign up for a free trial if you're interested. I'd love to keep in touch with you. That's why I got my little convention fishbowl back there to catch your business cards if you still do that type of thing. And please help yourself to a ninja mask. All right? Thank you all.